All right, Happy New Year. It is time for the very first variable rate update video of 2023. I waited a few days to kind of see what people were saying and the chatter on the market before I reached out to you so that you could have a really accurate guess. So, two predictions that exist. Remember, the next meeting is January the 25th. January the 25th, Bank of Canada meeting, which is the day that they will possibly amend an interest rate at that time, not before then. Two predictions on the market. One would be that they would not increase the rates further. Two would be that they would increase the rates by 0.25% and then stop after that. That seems to be consistent across the board. Not really a lot of predictions beyond that. Not really a lot of chatter for the Bank of Canada, and they really did leave the door open for them to do just that and not increase interest rates. The one report driving the idea of a possible 0.25% interest rate to finish things off is the job report. The job report really, that the numbers explode out of the water, that basically said we created a lot more jobs than were expected. Now, I would argue, and this is very important, that when we talk about a job report being robust, that's not an indicator of a strong economy. I know that people say it is, but it's not. The reason is just because there's more jobs, that doesn't take into account the quality of jobs. Are they more part-time jobs? Is it a situation where somebody's working a full-time job and now an extra part-time job, which I imagine that is part of the reason jobs being created, people working more hours. So that's not a positive per se. Is it a situation where there has been more lower level jobs created? Is it a situation where people that were retired and out of the workforce are now coming back in the workforce to work? Is it a situation where people that previously were not holding a job because they were self-employed and their business didn't work out, now they re-enter back into the job force? So job creation is not an indicator of a strong economy necessarily. In fact, my personal belief is 80% of the time it's not an indicator. Now, wage growth would be. So if all of a sudden the average wage is that people are making $20 an hour, and then the next month it's like, oh my gosh, people are making an average wage of $30 an hour, that is a much more decent indicator. And if you were the Bank of Canada, you could look at that and say, oh, well, that is an indicator that there's more money swimming around the economy, inflation could still run hot. That would make sense. I do not believe the job report makes any sense with increased rates. In fact, I actually believe it proves, the thing is about data is that there's more information that needs to come from it. Like, what kind of jobs are being created? If you'll notice, actually, in a lot of elections, that is often the way they poke a hole in an argument where a government says, oh, we created so many jobs. That's how the opposition party, regardless of political stripe, will poke holes in their argument and say, what are the quality of jobs? Are they good quality jobs? All that type of thing is an important thing they poke holes into. So what do I think is going to happen? I think that it is, I am hoping and believing I believe 100% the right thing for them to do is to not further increase interest rates. And I think there's a very good chance of not happening. I think that the 0.25% is on the market, but I think the fact that the Bank of Canada hasn't really chattered around that, I do really think they're leaning towards the rate hikes stopping. What options exist for you today? We've talked to so many of you over the holidays. First option is you can move to a fixed rate, which is about a point lower than a variable rate. Are we recommending it? No. I mean, we go through these reasons all the time. But if you wanted to go into the fixed rate, that option exists for a lower situation. I do think you'll have buyer's remorse, but hey, you can do that if you wish to. Two, the option still exists and should be something you consider. Way too many people carrying around high interest debt and saying, oh my gosh, I want to refinance because rates are high. Let's talk. You need to improve your cash flow. Lots of different ways to do it that don't necessarily include refinancing. You should also really think about the idea of doing anything to your property that can increase the revenue from it. Adding a suite, adding a carriage house. These are things you need to really think about. The reason I say is because the biggest increase year over year on costs is rent. Rent going up almost by 4 times. And you can have your own opinion about that, but it does go to show that the biggest way and the best way to forego interest rate increases is to do something to your property that does not affect your quality and standard of living, but adds to your property value and adds income to your property. So talk to us about that. There's programs where you don't even need to necessarily income qualify, lower credit, all that type of thing. The last thing is that you're really struggling, you can get relief programs. We have found banks to be a disaster on this, like let's just be candid, but people are getting them, but they're not easy and they don't seem to know what they're doing, but people are getting them. Relief mostly means you're stretching the amortization out. But I really want people to think about the fact that when I'm looking at my mortgage right now, I'm looking at two things. Do I believe interest rates are high on the short term? If I believe interest rates are high on the short term, then I'm probably riding out the storm. Riding out the storm, how do I afford it for 2 to 3 years? If I believe interest rates are like this for the long term, an argument by a lot of folks is that 5-6% are very normal interest rates historic over time, which is a true fact. Then I need to think about that there's no way around it. Too many people going, should I lock in? But if interest rates were like this for the next 5 years, then you're never going to escape this. You're always going to eventually encounter this where you have the higher interest rate. So you have to think about reallocating your budget accordingly. So the first thing is my income going to increase in my job? Do I need to switch careers, or where is my income going to be at? Where is my debt load going to be at? How do I improve my cash flow? That's the next question on. The move you may need to look to make right now is, maybe you want to downsize. Maybe you go, well, we got too much house. Well, you say, oh, the market is slower. Yeah, but the market's slower all the way around. So if I downsize and go from a house to a townhouse, some of that, because I feel overwhelmed by higher interest rates, I'm going to buy low as well. So I'm not really losing anything. I'm more transferring my equity. That could be a consideration for you as well if you're really strangled. Anyway, if we can help with anything, let me know. Please do take the moment to share this with any friends you might have. We love to give them a hand. And thanks so much, and have a great day.